All right, first thing I want to do is welcome you all. Thank you for showing up at the training for Marketscore. What I want to do is go through the chart and show you all the different pieces of the chart, because that's kind of crucial on how you would actually use it. So this is based off of the market profile, which is more commonly referred to as TPO. I'm going to go through the different areas and sort of explain a little bit about what they are and give you a little bit of understanding of how this actually is set up. There are the things called value areas, and that's the yellow parts. And this is where the price spends 70% of the time on a previous day. And of course, this has 3 previous days on it. It has the 25th, the 24th, and the 21st. Then there are the highs and lows. That's what that is. So this is the high and low of that day. Then there are the previous opens, and that's the light blue lines, and that is where that market opened on that day. There is the close, which is the yellow line, and then there is the POC, and the POC is where it spends the majority of the time on that day, and that's these lines right here. Now, the reason why these are actually on the screen has to do with the fact that the price movement is very often influenced by these levels. And so having them on the screen gives better understanding of exactly what's happening when things are moving. And I'm going to go through the parts of, or go through some of the days and show you how it interacts with that. And I mean, I guess you can see it right here. You can see how it moved up, it hit that previous close and rejected and came back down. So that's just one example where the price action is interacting with these levels. And usually the more prevalent day that it would happen on would be the previous day. So in this case, it would be the 25th. So I'm also going to go through the parts on the chart. We have is the market score data, which is what that one is. We have the market score chart, which is that. And this is just so that you can reference it and know what it is I'm talking about. There is the new high count for the upside, which is that one. The new high count for the downside, which is that one. The new low count for the upside, which is that one. The new low count for the downside, that one. The previous upside levels, which is what that is. And the previous downside levels, which is what that is. So it just gives you a history of when the score changes, what it was. And you can just look through this one or that one to find out what it has been. And then there is the chart itself, the trading chart itself. So to give you an understanding of market score, this shows the pressure in the market for movement to the upside, and this shows the pressure of the market to the downside. These pressures work independently because buyers are not, or just because somebody's not a buyer doesn't make them a seller, and just because somebody's a seller does not make them a buyer. And it's important to be able to have both numbers because it gives you the ability of being able to see where and how the market is behaving based on where the pressure is. And of course, as with all indicators, these numbers will not always be directly applicable to when it is moving up versus moving down, but it will give you insight and information. I wanted to show a couple of charts. I'm going to actually switch this. So I'm going to show this chart. Market score shows multiple types of information. The first is just the generic pressure. What is the pressure of the upside versus what is the pressure of the downside? The other thing it shows is the number of highs and lows, and this tells you the strength of that pressure. The more highs, or technically 15 highs or above is what I would call strong. 5 highs or below I would call weak, or 5 highs or lows. It's irrelevant. I mean, it works for both ways. But then the other key is between 5 and 15 shows strength, but does not make it strong. And the thing to keep in mind is that just because one side is weak does not always equate to strength in the other side. So it's important to just recognize when you're 15 or above, there is strength in that side. On this day, you can see there's strength in both sides, but it doesn't happen until very late in the day. At this point in the day, you can see the number of highs on the downside makes the downside significantly stronger. And this is at 9:44, so you're not even 15 minutes into the day, and you're seeing almost a complete strength picture for the downside, which is kind of what is telling in the fact that, and this is the third thing that market score shows, that you can see that upside is is strong in the fact that it's very prevalent, and you're seeing a lot of strength in it. But what's interesting is you don't see it moving up. even during this phase of the day, it is still moving down. And what's interesting is at 15 minutes into the day, there was very clear picture that there was strength in the downside. It wasn't strong per se, but there was strength in the downside. And because of that strength at 15 minutes into the day, you can see the market is trailing down and continuously moving in a downward direction. And ultimately, we end up going below the open, down by 15 points below the open. So it's kind of important to be able to see how that affects um, or how the score affects the actual outcome of the day. And it's even more helpful being able to see it that early in the day to be able to understand that there will very likely be some type of drop off or some type of retrace, or in this case, an actual reversal in the day where it actually goes back and completely goes down across the day. So in this chart, you can see that strength early on that shows that. This is another day where that happens, and this is the interesting part. You can see that the upside again early on has a lot of strength, and you can see that it's moving and doing very well. I mean, the score is doing very well for a better part of the day, even though the market is moving down. And this is the interesting part. On this day, you're seeing a lot of upside strength. The downside has a little bit of strength, but it's not strong, but it has a lot of weakness. What's interesting is in the overnight on this day, the market runs up 28 points in the Globex session. And of course, this is not an exact, it happens exactly that way, but what I'm trying to tell you is the pressure that you see in Marketscore does not always equate to it immediately turning into the actual outcome of that day. There are times when the pressure is apparent or is there and has an effect on it, but doesn't necessarily actually get to fulfill its desire in moving the market up. And on this day, it's a perfect example that Marketscore was really trying to push it up, or the market was trying to be pushed up, and Marketscore was showing this, but it just couldn't actually happen during cash session. And in the overnight, this was able to actually happen in a 28-point move to the upside. So that's how the pressure is important to keep in mind. And it is not always a matter of it showing immediately, but the point of Marketscore is to be a leading indicator, meaning that it can't always be a leading indicator where you're actually going to see it do something and the market is immediately going to do the thing that it says it's going to do. In this case, it just has to wait until the end of the day in order for that to happen. But at the same time, it's important to keep in mind. So I'm going to run through a few days to give you an idea of how this works. The first thing I want to do is I want to show you the chart. So this is the trading chart. Now on the trading chart, there's a model that does these buys and sells, or does the longs and shorts. The way that the model is set up is that the long and the short model are separate, meaning a long can only get into a new long if the previous long is closed, and the short can only get into a new short if the previous short is closed. And the reason why I do that is it gives you a lot of visibility into what's happening. And you can see that I will show you as we go through that it is common to see when a short gets out that a long gets in, and that potentially when a short gets out that it's a time for a long entry. And I'll give you some examples of that as we go. But first thing I want to do is I wanted to actually switch this. And part of the reason why I'm going to do this is I'm going to switch it to just show focus trades. And the reason for this is it'll make it a lot easier as we go through this for you to be able to see the different trades that I'm talking about. So on the chart, there are 3 spots to pay attention to. A lot of people get caught up in the fact that it shows a -10. This is not meant to be how you would have taken the trade. The focus, or the way that the focus trades are taken, is there are 3 fields to pay attention to. There's the entry, there's what I call HBP, which stands for heat before peak. And what that means is how much heat is that trade taking before it reaches the max level? Oops, the max level. So how much heat does it take before it reaches whatever is in the max position? And the goal of this is to give you an idea of how much heat you would have had to endure in order to get that full 10, in this case, a 10-point trade. Now, the other thing to keep in mind is this entry is not meant to be a definitive, this is exactly where you should be getting into the trade. The goal of the entry is to give you an idea of where the model is getting in, but very often you will be able to beat this number. This number is not, and the way that the model works, and you can see, if you look over where that arrow is, you can see the blue, how the candle turns blue when I move my mouse over it. It'll show you the entries and the exits of all of these trades as I'm going through them. The way the model works is that for a short, it chooses the lowest point on the candle of the minute that it's trying to get in. And the reason for that is to give you a more reasonable level of entry. And as you'll see as we go through these, it will become more clear that it is 95, and it's probably even higher than that, but 95% of the time you should be able to meet or beat this number. The other thing to keep in mind is that these trades are meant to be taken multiple times. The goal of these trades is to allow you to get an idea of where the pressure is equating to that type of trade, but doesn't necessarily mean that you would get in and then hold it for the entire time until you reach the max. Now, obviously, there are days when that is applicable, and that would be days like this, where when this trade opens, I mean, there's really no, I mean, you would potentially take it twice. You would get in here, and I'm not going to go through the details just yet, but you would get in here, it would go up, and then when it came, and you would get out, and I'll explain that in a little bit, but you would get back in when it gets back to that level, and then you would just watch it and see if it comes, see how it's behaving. And on this day, you potentially could stay in this trade for the entire day. And I'm not saying that this is how you should trade it, because of course staying in a trade for an entire day is kind of a difficult ask. But I can't imagine anyone complaining about 313 points, even if you got 200 points or 100 points. I can't imagine saying, oh, I had to stay in a trade all day, but I got 200 points out of it. No one's you're gonna be crying all the way to the bank. I'm just saying it's not easy to do, but at the same time, the goal of what this is to give you an idea of how to better trade and the information that you need to decide, should I stay in the trade? Should I get out of the trade? How should I be executing and handling this? So there are a few different types of days. So I'm going to go through some different types of days. So this is a day where the price action is moving above and below. So this is the close of that previous day. So this is the 27th. This is the close of the 20, or this is the 26th, the data of the 26th, and this is the close. When it keeps coming above and below, this is a day that is difficult to trade. And the reason why is because this is a magnet. And on this day, you can see it. It's going up, it comes back down. It goes above it, it comes back down. It goes above it, and then it gets above it again, and then it comes back down. And then it goes right back to it, and then shoots above it right toward the end of the day. That the close of the previous day is very often a magnet. And it's important to keep that in mind, because on days like this, particularly when you're dealing with such a tight range, a range of only 24 points, you have to be cognizant of that, because you need to adjust your trading style in order to manage the limitations of where you have the ability to make the trades. So this is a day where it does that. This is a day where it's above the day, but you can see it gets drawn to it, and then it falls below. But you can see that it's still being drawn back toward that close. It's a very constant thing. Here's another day where, again, it's going to cross the settle multiple times. So it goes above the settle or the close, it jumps back up, it tries to come back to it, can't come back, comes back down, gets below it, goes back above it, comes back below it. Very common thing. Now, there are days where it stays mostly to one side. And this, again, should have an effect. Now, you can see that for the most part, it is a magnet, it's pulled it up. it keeps basically staying below. And on this day, it's for the most part stays below that the close. And then there are what we call flip days. This is a flip day. It starts above and then it drops below, and then it pretty much stays below the whole day, the whole rest of the day. And then there are days when it actually stays and it never reaches it. It stays below the settle the entire day. It does get to it and does reach it. And again, it acts like a magnet. It comes down. You can see that the market is moving. It comes back right back to that settle. And again, these are the reasons why these items are on the screen, is because they are important levels to keep track of. The other thing to keep track of is like the value area low. So this is often a magnet as well, or a rejection. And you can see that it does break below it, but then it comes back up, comes back, and you can see it gets right to that value area low, and then immediately comes up and never gets back there again. And being able to have those levels on the screen makes it easier for you to be able to make decisions based on that. And then we have trend days. And trend days are, I mean, I'm sure you guys know exactly what a trend day is. This is a perfect example of a trend day. This is another example of a trend day. It's where it starts either above or below, and it never gets really back in. It doesn't ever get back into the value area, never even gets to the settle or the close. And you can see that this basically breaks right into that high of the previous day, and then rejects, and then runs for the entire day to the upside. Okay. So now we're going to talk a little bit about how to trade with Marketscore. So the first thing to keep in mind, and I'm going to go through NQ and ES. I'm going to do the ES first, and then I'll switch over to the NQ and show you how to trade those days. But the idea is that you should not have to have like a crazy stop. And when I say that, I mean there are times when I've been in trades, and sometimes when the market is really volatile, you're having to use 10, 12, whatever. Mostly on the Nasdaq, not necessarily on the ES. But for this, your stop shouldn't have to be more than, let's say, 3 to 5 points. Now, obviously, it depends on the market, and there may be days where it is moving much more rapidly, but at the same time, 3 to 5 points is a rule of measure based on that. And then when you're first getting into a focus trade, the first time you take it, and again, this is the reason why I say this, you are very likely going to be taking that trade multiple times. But the idea is that you would get in, and the first time you take it, don't let it just completely go against you. Don't leave your stop way out, or don't leave significant amount. I mean, if it goes up 4 or 5 points, don't move your stop up to break even. The idea is that you're trying to gauge how the market is behaving. No indicator is ever going to tell you exactly what trade to take and how to take it. Marketscore tries its best, and I will tell you the days that I'm going to show you are days when it is not the easiest day to trade, but the idea is to show you exactly how to use those days to your benefit. So on this day, you can see that very first trade right here. It's a short. Now, the entry on this trade is 55.26, and you can see that candle is actually goes all the way up. You can see down here, this actually shows the high of the candle. Okay, so the high of this candle is 29.25, but it shows 26.75. Now, because the next candle is actually is basically midway up it, you could get a better entry than this. But for the sake of argument, I'm just going to say at 10:28, so 1 minute, so the very next candle, you get into this trade at that exact level. Now, if you're trailing your stop just a little bit, the maximum movement of this trade goes all the way down to 22.5. But again, I'm trying to give you guys realistic understanding of what you would do. You would trail it. So let's say it comes back, so it's down at 22.5. Let's say you move your stop to 24, it stops you out. Now, you can see, and it's right here, you can see that initial candle, it stops you out at 24. So now you're waiting for it to come back to your entry or better than your entry. Now, in this case, it does come back. You get back in. So let's say in the next trade, so right in here, you would get in at 27 because it comes, you can see that it comes back. It goes up to 27.75 is the high of that candle right there. So let's say you get in at 27. Now this comes down, but it only comes down to 24. So I'm just going to say you don't get out. You move your stop to break even. It comes back up and it stops you out at 27. So that one is a scratch. But then it comes up and it moves up. Now here's the important part. The reason why I have the value areas. Now keep in mind that as this chart is drawing, this chart would be across the whole screen. You would have this area up here would be over near this day, and you would be able to see that it rejects a little bit below, but rejects off of this value area high. Now, because you don't just immediately jump in just because you see it's a small rejection, you're gonna I chose the next entry at 30. So you're not going to immediately get in, but you can see that because it doesn't get to the value area high and it gets over to here. So you're basically 2 minutes after it had reached that and rejected, you're going to get in at 30. And then if you got in right here at 30, you basically get into the trade and it immediately goes past you and it never gets back to your entry. Now this trade goes all the way down and the low point on this trade is 16.75. I have you getting into this trade and staying in the trade and exiting at 20. So that's 30 to 20. So that's a 10-point trade. Now it comes back up. Again, it doesn't get all the way up to your previous entry. And I think it doesn't get back up to your previous entry. So you wouldn't take that trade. You wouldn't. So once it comes down and you get out, it doesn't come back up to that 30. You're not getting back in. And then this point where it's actually coming back up and it's going past that 30, it's moving through it. So you're not getting back in. It's basically riding it and then moving back up. And I think it exits up here. It exits that trade, and you can see it in this candle right here. It exits that trade right there. So of course, once it's exited that focus short, you're no longer taking that trade. Now the long happens up here, and because it actually is just barely breaking above, and again, the majority of your day is already below that close, there's no reason that you would ignore this. This would be a trade you would just ignore. There's not enough movement on it and you're not going to see it. So it would be something you would just ignore. Next trade is, again, a focus short. It gets below and you see it get in right here. The entry time, so this has a 12:41. The entry time would be 12:42, so the next candle. It has it at 35.5, which is, as you can see, right down in here, and you can see that next candle is a little bit above it. So 35.5 is a very reasonable entry. I have you entering that trade at 35.5, which again, very reasonable. This goes down again. So when you got into that trade, it never gets back to your entry before it goes down. So you get into that trade right there. This goes all the way down to 29.25. I have you getting out at 31. So you get in at 35.5. You get out, it goes down, it comes back, stops you out at 31. So I'm even giving, again, more leeway than 3 points for that return, because again, it's all dependent on what is happening in the market. And with this showing you that this is the downside is the way, and again, the majority of the chart at this point in the day is still below that close. So the short is definitely the right way to go. The second time you would take this trade, so it gets you out here. The second time, it gets back up to the 35.5 right here at 13.14, right there. It's back above the 35.5. That was your previous entry. That is where you get in again. So before that point, it basically is meandering around. 35.5 is your entry. You get in at 35.5. This time it goes all the way down to 26.25. On this trade, I have you getting out at 27.5, which gives you 8 points. Now this one, because, and this is the key, you can see it basically hits the POC, and this is another reason why it's important to recognize these. So it hits the POC and rejects. Now, 27.5 may be a little bit aggressive, and it may be more like, let's say 29, but either way, that's a 6.5 point trade. So 8, 6.5 points. In this particular instance, it's somewhat irrelevant, but you get the point. Very, very clear information as far as whether or not you should be staying in the trade when it rejects off of the POC, comes back up, and it doesn't really get back to the POC. So again, that would be the point where you're wanting to get out of the trade. The third time you take this trade, and this trade stays on until all the way until the end of the day, you can see that the exit is way over here at the end of the day. The third time you would take this trade, right here, it gets up to 35.5. It actually barely touches 35.5 right here. So again, another entry, 35.5. This comes down, and the low point on this is 31.25, and I have it getting out at 33. But at the same time, the important thing to keep in mind is if you're in at 35.5, it's not really coming back to or coming past your entry, so there would really be no reason to get out. I mean, and potentially you could hold it all the way down into here. But the idea is that if you decided to get out somewhere in here, you're getting 1, 2 points, whatever it is you're getting out of it. The idea is just in reference to the fact. And the other thing to keep in mind is notice this rejects off of that close. Now we're not even reaching the close on these moves up. And then we get down into here, and again, we've already sold that other one. But then we get above the settle, above the close. It comes back through. Now this time, because we got above there and we're coming through it, it moves right in here, and you can see these candles going sideways. The entry would be at 36.5 for this trade down. This one comes down all the way to 27.5. So I have you getting out at 28.5, somewhere in here. Again, that would give you 8 points, but at the same time, even if it was 5 or you wanted to have a 3-point stop, whatever that would be, 27.5, that would be 30.5. So at the very least, you're getting 6.5 points out of it, or 6 points out of it. So, and then and while that trade does go on for the rest of the day, it doesn't get back to your previous entry, which is 36.5 now, until way over here, but it does it in an upward candle. No reason to take that trade. So you would be done. That would be the end of your trading for that day. And on that day, you would have made 20 points. So this would be a day, and keep in mind, I am choosing difficult days on purpose, because on days like this, there's not really a question of how to trade it. I could show you charts like this all day long and say, oh, look, it does great. You could make 313 points. But that, in the end, the goal for me is to give you guys the tools on how to actually trade days like this, because there are a lot of days like this. And mind you, in looking at what I'm showing you, there is a lot of data, and I'm certain that there's a lot of things to understand. But once you understand these levels and you get used to going, oh, it's going to reject, or it's going to push through, or it's not going to, whatever from that close or the value area low, it's much easier. And seeing this on the chart as the day is progressing makes it very easy to understand. And you can see the majority of this chart being below that close. Those two are the only two trades that you really should be paying attention to. This one is just an ignore trade. And I'm not saying that you couldn't take it for, I don't know, a point, and the other thing is that you got to keep in mind, the reason why I leave all of these other trades on there is there are trades that have validity. I mean, you could take this long for 16 points. But the reality is that isn't a trade that I can be certain as it is based on the model that I'm trying to teach. And this would be effectively, based on the model, a fade trade, because it's against the model. It's not a focus trade. But I mean, you could make 16 points. It's not a bad trade. It's just not necessarily the trade that I'm basing this on. But I still put it up on the screen because those are trades you can take. It's just not necessarily as easy to manage them, and potentially you wouldn't take them multiple times. But that's a story for a different day. All right, so This is the next day, which is the 21st on the ES. And again, I'm going to go through the ES charts, and then I'm going to go back through and show you the NQ charts for the exact same days. This day, much easier day. Everything is below the close, and you only get 2 focus trades. Again, I'm going to switch this just so you can see what the other trades are. It does show there are other trades, and again, there is a long that is 14 points with 4.5 points of heat. But the point I'm trying to make is that by switching to this, it's just an easier play. Okay, so the first trade right at the open. So at 10:01, you're taking this trade. I have your entry. Now keep in mind, look at where that candle is. Look at this candle where that gets into a trade. That is a very long candle, and this is a long, or this is short. That candle ends at 32.75, but it's putting the entry at 27.5. So it's 5 points below that entry. The very next candle is at the high of that candle is 31.5. That would be approximately where you would be getting into that trade. I have the entry on my notes at 31. So again, you're getting into that trade at 31. The bottom of this trade, so it goes down and it basically peaks out down here. The bottom of that trade is 30. So I have you moving your stop to break even and stopping you out. So you basically, it's a wash. That first trade is a wash. But again, when it comes back up, and because it's moving as quickly as it is, now mind you, the 27 is now irrelevant because it's not the 27 that you're taking that trade, because now you entered that trade at 31. So anything less than 31 is not the trade you're taking. So when it comes back through, when it's moving through that 31, it is moving strong to the upside. So you would not get in. It goes up, it gets up into here. The trade you would take, and I have you taking it from the 35. So it gets all the way up to the 30, 38 or 37.75, and you're getting in at the 35, which is right here. So it's significantly below the top. And you would get in. This trade comes down, and it goes down to, or I'm sorry, you get in at 35. It comes back up to the 36.5 again, 3 points. You're not getting out. It comes back down. This moves all the way down to the 29.5 right here in this candle. So you would move your stop up. You would have, it would get you out at about 32. So again, that 3 points. So it gets you out at the 32. So you get 3 points of profit. Then again, you're waiting until it gets back to the 31 or to the 35, sorry. This time it comes back up. So it moves along here. This time it comes back up and you get back into that trade at 10:51. So right after it peaks, and you're getting in this one at 36. So it peaks at 37.5. So you're getting in at 36, which is the next candle, or well, as it's coming down, and then potentially the next candle, it is above that at 36. So you get in at 36. This time it comes down. The low on this one is 31.25. I have you getting out, or have you exiting the trade at 34 for 2 points. So you get in at 36, get out at 34. Again, your minimum entry is 36, but that trade closes at 10:59. So this trade actually exits right there as it's moving back up. So you had just gotten out of that trade. It exits right there. You're no longer taking that trade. So now the next one comes up and it opens at 11:15 or 11:13. So it opens after it goes back up and it starts coming back down. You would get in potentially over here at 36, I guess 11:13. No, it doesn't even enter until here. So at this point, because it's moving right in that general vicinity, I would probably say even if you did get in, you would potentially lose whatever the points are. But I would say that I would wait until it got a little bit above that because of the fact of this move up. But the 36 entry over here, or pardon me, the 36 entry on the downside, even if you got in here and let's say you got stopped out, once it rejected and moved back down, and again, it isn't getting to that settle, it's staying below that close. So let's say you got back in here at the 36, so that your entry is at 37.25. So just a little bit above that. So 37.25, and your exit would be down here at the 32. So I don't even have you exiting all the way at the bottom. This goes all the way down to 27, 27.75, 28.75, pardon me. So if you got in at 37.25 and got out at 32, that's 5.25 points. But let's say you did get in and you lost 3 points, and then you did get back in, and I mean, just because this did get back down to the 36, but at the same time it barely breaks the 36. So again, this is, for me, is kind of an iffy whether or not I would actually get back into that right there. I might wait until it gives me a little bit more indication. But either way, you lose 3 points, you make 5.25, you're still up 2.25 points off of that trade right there, not to mention the previous trades. So then the second trade comes in at 12.08. So now again, because this is moving down, you're waiting until it gets back to at least to your entry. And when it comes back up to that 37.25, it's moving up. So there's no reason to get back into that trade yet. Once it gets up into here, and this is the key, again, the key thing to keep in mind is that close, when it rejects off of that close, that is the clear signal of when to potentially get in. In this case, you would get in at 12.08. 12.08 is right there. So it comes down, you get in at 12.08. I have the entry on that, 55.43, which again, the reason why you would get in is because it rejected off of the previous close. So 55.43, you would write this down. Now, because it's not getting back to that entry or getting basically close to that entry, I would potentially leave my stop right there at either that or maybe at a point up and let it play out, just because it rejected off of that, and give it a chance to decide what it's going to do. When this comes down, I mean, this ends up going all the way down to 24.25, which potentially would give you a 16-point trade if you got out. And I have it getting out at 27, which the reason why I have it at the 27 is because that's the low of the previous day. That's where this is that. And again, this is the reason why you would pay attention to those levels. Technically it's 26.5, but you get the point, or the value area low, and 26 I think is actually where the low of the day is. So potentially you would put it at the 26, but it would be a matter of giving it a little bit of freedom rather than just a 3-point stop. But either way, you could potentially get a full 16 points out of that. So that's, and then at that point, it never gets back up to your entry level of 43. You're not getting back in. That's the end of the trade. So even though this trade doesn't get out until the end of the day, and potentially you could take it a couple more times or whatever based on the movements up, but at the same time, I'm trying to be realistic in what I'm actually explaining to you guys, is that you only get at or better than your previous entry. Okay, so the next day. So the next day, again, this day is a little bit harder. And the purpose of me showing you this is to give you guys a realistic expectation of what and how to use this data. Now, again, because we start above the close, the long is the appropriate trade, but at the same time, it eventually gets to the point where it breaks below, and then the short becomes the appropriate trade. So in this case, this long shows up at 73.25, and you can see it doesn't move up anymore. So you get into this trade, it comes, or I have you getting into this trade at 71.5. It gets down to 71.5, and again, the goal is to get the best entry, and because it's a long, you would try and get in as low as possible. So 71.5. When it comes up and you move your stop to a reasonable level and it comes down, I have it stopping you out at 2.5 points, negative 2.5 points. So that first trade, negative 2.5 points. So at that point, and you can see this trade exits right here when it gets down to here. So that trade, basically negative 2.5 points, you're done with that trade. Now, the next trade that shows up is a short. Now, this trade, because the market score is showing strength to the upside and significant strength to the upside, this would be a trade where you and potentially you can see that it's right at that close. This would be a trade that you would hold off. So you wouldn't take that trade. Next trade comes along. The third focus trade is a long. We already got burned on the first one. It's too close to the settle. You would ignore that trade. even if you did take it, so let's say you got another negative 2.5 points. Bottom line is that you would see that it wasn't really giving you the movement up that you really wanted. But eventually we get over toward this trade, and it goes for 30, well, potentially 35 points with 2 points of heat. Now, this trade I have you entering, and you would take this trade potentially multiple times, but it would be based off of this settle information. 56 quarter is the initial entry on this. So you would get in at 56 quarter, you would ride this down, and I guess at this point you would potentially only take it the one time, but you could take it multiple times, as you can see with the movement, but it's all dependent upon how it behaves. Now, once you see it reject like that, and particularly go below the low of the previous day, that usually is a decent sign that there's not, that you are going to get continuation in that direction. But at the same time, even if you only took it one time, this trade right here, enter at 56 quarter, your exit would be at 38 with a possible max of 33 half. So I'm still taking 5 points or 4.5 points off of that trade, and that gives you 17.75 points. So even if you lost 2.5 points here, 2.5 points there, you're going to get back 12 points. So 12 points on a day, not a bad day. Now, even if you didn't take any additional trades, and for now, I'm going to assume that we didn't, just so that I can go through the NQ trades. So now we're going to switch over to the NQ. Rules of the NQ is a little bit more complicated because the movement on NQ is substantial. I mean, it's very often very volatile and very difficult to stay above. Now, as you can see, there are 5 different types of trades, or 5 different trades, and we move back and forth across this a lot. So I'm going to go through these pretty quick, but I'm just going to give you guys an idea. So the first trade right here at 10:01, let's say you got in at 10:01, your entry, because again, look at that candle, you can see that candle's pretty long. I have you entering it at 80. So I'm actually using this because it's very close. You can see that next candle does go down a little bit below that, but we'll just assume that you get in right at 80. This goes all the way up to 16 half, 16 quarter. Or if you held on to it all the way down, then this one goes all the way up to 23 quarter. But I have you exiting it at 20,005. So way before, 15 points before that. Profit goal on a NASDAQ trade is between 20 and 35 points. The stop should be between 10 and 15. And again, maybe longer if it is a very volatile day, but 10 and 15 points should be what you should try to adhere to. Now, as you can see, it basically at your entry at 80, once you enter into this, it comes back down to the 75, I think is what that next candle does. And then it never gets back to that level. You're never back at that 80. So at that point, it's not really a question of how, of what kind of stop you need, because once it moves up 20 points, you should be moving your stop up as well. And again, so the maximum potential on that one would have been 20.75 for that trade. So that trade closes on that move back down. So that trade gets out, you're not getting back in that trade. And again, when it comes back to that 80 level, it is moving down pretty rapidly. So you wouldn't be taking that trade. Next trade is a short, because it actually comes down and basically just broaches that. You're not taking that trade. It's moving too fast, and you have to wait for confirmation to the downside, and it ends up coming back very quickly. You can see that it comes down and immediately comes back. The third focus trade is a long. So that one's right here. So this trade you would get in. I have you getting into this trade at 9.85. So I have it actually a little bit better, because of course it is, that next candle does go down further. So it's a little bit better than that entry. So 9.85. I have this goes up all the way. So the max on this goes up to the 90, goes up to the 95. So you're in at 85, it goes up to the 95. I have it stopping you out at -5 points. So then the second trade, so now it comes back down. The second trade, you're getting in at 10.43, which is right. So it comes back down into here. I have you getting back in at 10.43, and an entry again at 9.85. You could get back in below this. Again, it's just a matter of uh, of where you want to get in. I'm choosing, like I said, somewhat pessimistic entries. So your exit is up at 2,000, but this goes all the way up to or 20,000. This goes all the way up to 20,008 quarter. And if you get out at 20,000, that gives you 15 points. So that's that trade. That long, it completes right here in that downward movement. So you're already out of that trade. The next trade is another long, and this long gets in. You can see it right here. It gets in right here. It has an entry of 72.75. I have the entry at 70 because I mean, you can see that it comes back down, and we're very well below that 70 right here. So this comes all the way down into like the 66, it looks like 67. So the 70 is a reasonable entry. I have you exiting at the 2015. You can see that this right here, this 70, once you're in, it pretty much never gets back there. I have you exiting all the way up at the 20,015, so all the way up here. It goes all the way up to the 20,027. So 20,015 isn't necessarily unreasonable. Profit on that is 45 points. So again, your stop would be, what is that, 12 points below? But again, uh, even if you did it at the 10, that's still 30 points or 40 points. So I'm sure you guys are getting an idea. Okay, next, it comes back down. It's moving through this pretty quickly, so you wouldn't get back in right here. The next entry time is 12:58, which is as it's coming. So it rejects, and again, so you can see that it's not quite getting to the POC. It rejects, it's coming back up. I'm having you get back in at the 970. So the 970 comes up. It doesn't really go very high. It comes back down. I have this one, an exit. So your entry is 70, your exit is 65. The max it goes is 77. So you're getting a negative 5 points on that trade. And mind you, I'm showing you a lot of what the trades could be. Clearly, the point is that you would not be taking all of them. The idea is just to give you an idea of types of trades you could be taking with it, and what happens if you take any of the ones that are being shown. This last trade, because there's not enough strength on the downside, like right here, you can see it's basically break even. The scores are, I mean, you can see that the upside has the strength, the downside is what we call weak, and the scores are not really showing you that short is a good trade. So while it does make 35 points, and while I am certain you can make profit out of it, in this case, I would say ignore it. Ignore that trade. Okay, so we're going to go to the next day on the NQ. Okay, so this one, again, we have, what is that, 6 trades? I'm going to go through them hopefully quickly. All right, first one, you're getting in at 10:01. Your entry is at 970 again. As you can see, it's right over here. So 970, this is a short. You're exiting at 960 right here. This trade goes all the way down to the 49 quarter. So it goes down basically to the 50. So again, a 10-point stop. So that's a 10-point trade. It comes back up. You're getting past that entry, but while it is moving through at the 970, it is moving right through it and does not come back. So you would not get back in that move up. This trade closes. So it closes in that move up. So you're not taking that trade again. Next short comes along. This one, you would get in. This one is a losing trade. You'd get in down here at 1034. You get in at 954. Your exit is at 960. The max it goes down to is 43. Potentially, you could get points out of it, but the idea is to just, again, I'm trying to give you guys a pessimistic view of these trades, just so that you'll understand exactly how overall well this performs. So that one would be a negative 6 points. Again, that trade gets out at 1046. So after it comes down and does this back and forth, it exits that trade on the way up. So again, that trade is now done. So then the third trade comes along. Because the third trade is happening, you can see it rejects right off that low of the value area. Or pardon me, it doesn't even get to there. It actually rejects before it gets there. This would be a trade you wouldn't take. because it's in that upward movement. There's, as much as it is a short and we are below the settle or below the close, that would be a trade you would wait and not get in. So the fourth focus trade shows up here. This trade, you would have a delay because of that move up. So you wouldn't get in, and even if you did get in right here, I mean, you would potentially get stopped out. You would get back in after it comes back up. And again, this is the key. If you see it hit the close and it doesn't break it with significance, it's telling you it wants to go back down, or it tells you it wants to go. So it hits the settle or hits the close and comes away from it. So either you could get in here and basically lose that trade and then get back in up here, or you could just wait for it, because it's that close to the settle, wait for it to see what it does at the settle or the close. And when it gets to the close and it rejects, then that would be where you would get into this trade. The entry on this trade, and I have it fairly significant away from the high of this, which is 48, 49. I'm sorry, 38, 39. I have you getting in at the 20, so all the way down here. So you get into this trade at the 20. This trade goes all the way down to the 76. I have you getting out at the 86. So at that if you got in at the 20 and got out at the 86, so 10 points from the low, that would give you 33.5 points. Even if you got out at 15 points, that would still be 27.5 points on that move down. But again, it's a better entry. That's the reason why you're getting into that trade. You're getting into that trade is only at a better entry. Then it comes down and then it moves back up. Again, that trade exits. So we're in that down. This trade exits on that way back up. Because it's moving up through that 20, potentially you're not getting back in. And then you wait for it to come back up. Then we get a long. Now, the long, because, and again, this is a preference thing, because it is barely just for the first time moving above that close, I wouldn't take that trade. There is definitely money to be made. As you can see, it ends up going for 31 points with 7.5 points of heat. It's not a bad trade, but because of the overall information, I'm not taking that trade. Then it basically meanders around, and then this last trade is where things get a little more fun. Now, as it moves through that settle, once we get below it, this trade right here, the entry on this trade is showing at 20,011, but you can see that next candle is going up much farther than that. I have you getting in at 20,015, so right here. So then it comes back up, doesn't really get above that. It comes back down. Again, if you left your stop there, is up to you. But if it came down and you got enough points, you would close it out and potentially get it back in when it got back to this 2015, or it gets close to that 2015. Again, this is a preference thing. But as you can see, it does end up going all the way down. The max down here is 47.5. And if you had stayed in that trade from 15, it's a potential 53-point trade. That's if you're getting out at 62. So 47.5 is the bottom, but 62 is where I have you getting it out. That's 15 points, which would give you 53 points from that trade. And again, because it's not getting back up to that level you were in at up here, you're not getting back in. So the rest of this day, you're not trading. But for 50, I mean, and that day, I mean, we'll just add it up. It's like 80 points, give or take, even with the 6-point loss over there. Okay, so now we're on to the last day. This is the one where on the ES, it actually was above at the beginning and then below at the end. On the NQ, it actually dips below. So on this one, this first trade, basically you're getting in at the 1001 at 20,220, because of course you're getting into a long and you can't really see it, but basically that next candle is right there. You're getting in at the optimal level because that candle goes up extremely high, which is the reason why it says 20,004. But so 20,020, you're getting into this trade. It goes up to a maximum of the 230, and I have you getting stopped out at the 210. So I'm on that trade. I'm actually even giving you even more leeway of 20-point stop from where it goes, or a 10-point stop from your entry. and it gets you out for negative 10 points. The next trade, again, now we've broken below the close. Key information, we're breaking below that. This trade has you getting in at 20,187, but you can see that we are actually right at the 20,200. So this trade, I mean, and even if you didn't get in right there and you wanted to see a little bit more continuation, as you can see, the bottom of this trade goes all the way down to the 20,118 from the 200. So even if you got in at the, I don't know, the 75, that's still a 30-point trade. But if you did get into the 20,200, you're getting 60 points out of that trade. If you exited at the 140, this goes all the way down to the 118. I have you getting out at the 140. So again, I'm giving a very pessimistic view. This could be an 80, almost an 80-point trade if you actually took it beginning top to bottom. But I'm only taking 60 points out of it. So anyway, again, that trade exits on this move up right over in here as it's moving up. So again, you would only take that trade once because it exits as it's coming back up. Then there's a long, and again, you're not taking it because we are barely breaking above the long. And as of this point right in the day, the majority of your chart is below the close, which is what this time right here is. The majority of your chart is below the close. That's not a trade you're taking. So you're ignoring that long. Then the next trade comes along, and again, the NQ is very, very, very helpful when it comes to having points that show up. There's this trade. Now the entry on this trade is 187.25, and you can see that it is meandering around, but you can look at Marketscore at this point. Now on Marketscore, the downside is moving up, but not necessarily to the point where you were getting crossover. And this is the thing, is that given the fact we're that close to the settle, and even if you got, I'm just going to say this, even if you got in and you get stopped out for 10 points, fine, whatever. But I would look at this and say, you know what, given where we're at, and given the fact the downside is moving up, it definitely is a good trade. Or maybe you just give it more heat, either way. Once you see this crossover, that's the big sign of when to get in. And I have you getting into this trade at 1150 right here. Now you can see the 1150 candle is pretty long. It goes all the way down 20,160 or 155 probably. We'll say that. But you can see that it immediately runs back up, and the very next candle is pretty far up there. I have you entering this trade at 170. So even though it goes all the way up to like the 175, I have you entering at the 170. So this trade, I would have you entering at the 170. But you can see it pretty much at that 170, if you just kept your stop, let's say at 180, it's not really getting back to that level, and then it plummets drops like a rock. This trade goes or the max on this goes all the way down to 12. I have you getting out at the 20. So the 70 to the 20 is 50 points. Now, you could potentially stay in even through this move up. Again, this is all a preference thing. But again, you wouldn't get back in because it never gets back to that level. But if you did stay in, I mean, as you can see, you can get this all the way down to the 960, 970. So that's the 70 to the 70, so that's 100 points, which I don't know if you really need to make 100 points, but anyway, that's the basic gist of it. Now I want to open it up for questions. So I've gone through some substantial days. I've shown you some of I mean, these are easy days to play. Marketscore gives you a lot of clear information at the beginning of the day. This is a gap up day. So if you got into that trade, and I'll just use this day as as an example. This would be a day where you would get in. Let's say you got in here, and then it came up to so you got in at the 57, it comes up to the 75. This would be a day where you would take, let's say 5 or 10 points or 15 points, whatever. And then it comes back down. It gets to your entry again. And then potentially you take that trade again, or let's say you take it from the 50 this time instead of the 57. So you get in at the 50, it never gets back to that level. And you could stay in that trade literally all day long, all the way until the end of the cash session. Is there a day you guys want me to look at, and you can and have me show you the data and then go through it and explain?
I think there was a question in the chat about time frames.
The chart is based on a 1 minute candle. Are there any other questions that you guys have?
I have a couple of questions.
Sure.
The focus trades, that's underneath the sector information. Is that the list of focus trades there?
Yes, these are the focus trades, and the normal chart looks like this.
Okay.
No, that's what a normal chart looks like. And I just switched it so that you would only see the focus trades, but it's, just for the sake of simplicity. But
you were going through each of the trades.
But I was going through only the focus trades. The trades that I was doing were only focus trades.
Okay.
Unlike some of these days, on the NQ, it literally gets a little bit daunting. You'll see. There's just a lot of trades in there. And I'm just going to show you one really quickly on the 21st. So on this day, one of the things that I was talking about, I'm going to switch this. I was showing this second trade, the entry at 55.43 was the entry on this trade. I think this is the second time at 12:08. So when you're entering up here at 12:08, you would just put your stop at the close. And as you can see, it never gets back to the close, which is how you would operate that particular trade. I just have that on there. And then the exit would be down here at the 20. I think I mentioned that exit would be at the low of the previous day at the 26.
So there you say the entry is at 12:08. Is that right?
Right, which is right over here.
And when I'm looking at the focus trade, is that 12:08 a focus trade or no?
So here's the key. The focus trade is not meant to be a static, you take it one time and that's it. The focus trades are meant to be taken multiple times.
Okay, so from that level.
Well, from this level or better. Yeah.
Okay.
The idea is to give an approximation, to give you an idea of what is potentially possible. Because in the end, as you know, the market is going to move back and forth, and the goal is to try and optimize how much you're getting out of it. Like some of these trades on this trade right here, let's just say this trade, for example, is a good example. This trade, you would only make, if you stayed in this trade and did it exactly as prescribed, you potentially have the maximum outcome of 13 points. If you take it the way that I was describing earlier, where you get in at this point and then take the trade multiple times, I have you making 21.25 points. So you could theoretically just follow this as is and get, a potential of 13 points. But I'm having you get out before it's reaching those levels. And this is like if you were to do everything perfect and get out at the exact bottom point, you would make 13 points. Mine, you're getting out 3 points above the lowest point of that cycle, and you're still making 21.25 points. So basically 7 points more than this, or 8 points more than this, and you're not having to be as optimal, because of course you're never going to get a 13-point trade out of that, because unless you're actually putting your exit at this bottom tick, you'd never hit it. So the idea is to give you guys better than the ability of what this is providing. And and it's true for all of them. If you're taking these trades multiple times, this 35 points, I think on this day, this is day 3. You're only getting 15 points out of this trade, just because of the fact that in order to get that full 35, you have to get in way over here and hold it all the way until down here. And again, but on that day, overall, you're getting 17.75 points, for this trade, right here, you're getting 17 and 3/4 points. You're getting 13 and a quarter points. You're getting 5 points, 5 points, and then you're getting 15 points if you took this multiple times.
Mm-hmm.
If you took it every time it came down and then it came back up and got to, and the key is that it gets to levels of significant levels. Remember how I was saying you would only enter it again if it got back to your entry. Days or at times when it gets back to significant levels, you can see it rejects right off that value area low. That potentially would be an indication of a time when it's okay to get
Mm-hmm.
back into a focus trade
Mm-hmm.
when it doesn't reach your exact level. This would be a
Mm-hmm.
day when you could do that. And if you did that, the times, so in this case, it would be you enter at 21. So you enter over here on the way down, you get 17 and a half points. It comes back up. It rejects off that value area low. You get back in at 54, which is right in here. You write it back down. You get 13 and a quarter points. It comes back up. You get back in at 41, so right in here, because, and you can see this is the low of the day, and it's rejecting right off of that low.
Mm-hmm.
And so you get back into that trade, you write that down. I have you only getting 5 points because it comes back up so high right here. I have you only getting 5 points out of that trade. Then it
Mm-hmm.
comes back up, you don't get back in that trade.
Mm-hmm.
It comes back down. Then it comes back all the way up to the point and it hits the POC. It doesn't break the high. And I have you not even getting back into this trade until it breaks below the value area low
Mm-hmm.
at 1436, which is right here. Right when it's breaking below that, you get back in, and then you write it again down for 15 points. So on this 35-point possible trade, you're turning a profit of 17 points, 13 points, 5 points, and 15 points. So that's 35, 45, 35, 50 points. You're turning this into a 50-point trade.
Mm-hmm. Yeah, I noticed that. I used to trade Ethereum years ago, and it did that a lot. You could trade from the same level over and over and over.
Well, and that's again, that's the objective with focus trades is that you would be taking them. Now, mind you, again, you could take it just the one time and be done and get 2 to 5 points or whatever out of it. And on
Mm-hmm.
days like this, it's kind of a no-brainer. You get in, there'd be no reason to get out. But the
Mm-hmm.
majority of the days are going to look like this.
Right.
There's going to be some level of back and forth. And that's why I wanted to show you guys how to actually trade it on days like this. Because while this would be a really easy sales pitch, oh, look, Marketscore could make you 65 points in a single day. The problem is that at some point you have to actually be able to trade. And that's why I wanted to go through all the specifics of how to trade days like this. Because learning how to trade with it is the goal. In the end, you're going to have to be able to figure out how to trade when it is doing the back and forth.
Yeah.
And I can go. I mean, I literally could go. I mean, pick a day, and go through and show you guys how to trade those days. So this one would be a tough day. I will admit this would be a very tough day. But again, you would potentially be taking this trade multiple times. So you would this long, while it only shows 3.5 points on here, you can see that if you got in here, let's say you got stopped out, you could get back in here when it rejects off of the value area high of this day. And then you would get back in, write it up. It comes back down. It gets close to that. You could get back in, write it up again, write it back down. You could get in again, write it back up, write it back down. It breaks into the value area. You could get into it again, write it back up. Once it breaks through what it was trying to break through, that would be a time when you don't get back into that trade.
I see.
But that's the key is that, and this is the hard part, is people will look at this and they'll go, well, that trade only made 3.5 points. Well, it made 3.5 points based on the model, but the model isn't how you should be trading. The model is just to give you an idea of what is going on behind the scenes to help you better trade.
Thanks, Stacy. Appreciate that. At some point, I would like to pick your brain about how you come to those levels and in the focus trades, but we don't have to cover that now. what
Well,
the mathematics behind that.
it uses a lot of the value area data. Well, first of all, the key is that it uses Marketscore. Marketscore has a lot to do with how it decides when to take a trade. And the way that the way that this works, and I'll just give you guys a quick Reader's Digest version of how this works. The basic gist is that Marketscore decides the trades that it will take. Marketscore is the movement of Marketscore is what decides when it gets into a trade. Whether or not it takes a focus trade is based on the value data. But the value data or the focus trades will only trigger if it's already in a trade. So if there is a trade active, you can see this trade closes at 10, this trade opens at 10. This trade closes at 13:45, this trade opens at 13:45. The reason why I do this is because that way I know that the Marketscore information for that trade has already been met when it checks the value data to determine if it should take a focus trade. Because it's already in a trade, it's a no-brainer. That piece of it has already been established. Now I can just focus on the value data to determine should it be taking the focus trade. Any other questions? Someone asked me. Oh, I thought I mentioned this, but maybe not. I think that I didn't. Okay, so one of the other thing, the rules of how to trade. So for trading for the ES, again, so the goal is 2 to 5 points profit with each trade, multiple trades. So 2 to 5 points profit, 3 to 5 points stop at most, unless it's moving very fast, and then the stop trails the price as it moves. Risk management, until it shows strong movement, don't give it a lot of freedom. Basically, you're not going to just decide, I'm giving it 10 points of freedom because that's fine, because everything will be great. The idea is that you, if the Marketscore isn't strong in the direction of the trade, keep your stop tight. The goal is to maintain risk management. And the last thing to keep in mind is do not over leverage. You should be taking these trades with 1 to 3 micros. That's what I'm progressing, or that's what I'm professing as far as how you should be taking these trades. And if you're in 1 to 3 contracts, I mean, on the NQ, what was that day? It was more than 100 points, or was it 50 points? No, it was. So hold on. So there was a day you got 10 points, -6, 30, and 53. So that's 80. We'll say 80 points. So 80 points on the NQ. And if you're in 2 contracts or 3 contracts in the micros, that's
Pretty good.
let's see, that's 180. So 80 would be 160 per contract times 3, which is $540. So it's not really a question of whether or not you can make money using micros. It's a matter of how you do your trades. And the key from my perspective over the time that I've been doing this is, while scalping does work, and I'm certainly not saying you can't make scalping work. If you follow this model that I'm talking about, you don't have to feel like you need to jump out of a trade that quickly. Some of these trades, you're in them, I mean, clearly on a day like this, there's no question. You're in that trade for freaking ever. But like on a day like this, some of these trades you're in for, 15 minutes, 20 minutes. And I know that from a scalping standpoint, that's definitely a hard pill to swallow, but the goal is to maximize your profit. And if you're in 3 micros, the cool part is if 3 micros on the NQ, that's $6 a point. And let's say you have 10 points, that's $60. But if you have the potential of getting 20 points out of it, I mean, 20 times 6, you're at $120. So you potentially lose $60 or make $120. And it's all and that's just 20 points. I mean, some of these trades on the NQ, 50 points, 33 points, 45 points, 15 points, 60 points, 60 points. And again, these are hard days to trade. These are days when it is not easy to trade, to make those trades. But because of this movement, I mean, it just makes it easier. And I mean, this is the day where you could make off of this one trade, you could make 60 points, negative 10, 60 points, and 60 points. So that's 120 points. 120 points times 6. I mean, that's a lot of
Seven,
points.
seven,
Seven,
720.
$720. $720 on this day, on one single day, with using 3 micros. I mean, that's the crazy part is people like, oh, micros are, I'm not making any money. If you're only staying in the trade for 5 minutes or 3 minutes or 20 seconds, you're right. It is very hard to use micros and really feel like you're actually making progress. But in 3 micros, using what I just described to you, where you're taking that trade, this trade right here, 3 times, one is negative 10, and then 2 times it's positive 60. Okay, I apologize. It's 110 because clearly you would have lost the negative 10. So 110 points. But I mean, in 3 micros, you're still making $600+. So it's kind of a no-brainer that even though, and mind you, if you took one NQ contract, clearly it would be a much different animal. But the point is that you can still make good money using the micros, using a system that allows you to stay in a trade and make 60 points. And on the ES, it's very similar. It's the same premise. That 35-point trade on the ES, let me find it. That 35-point trade, you're making 17.5 points or 17 and 3/4 points, 13 and a quarter points, 5 points, and 15 points. So what was that? 60 points, 50, that's 30, 35, 50. So it's 50 points. You're making 50 points on 3 micros. That's
$750.
$5. Yeah, exactly. Because it's $5 a point. So it's $750 just off of that trade. That's not even the entire day. That's just that trade.
Mm-hmm.
And even if you were less aggressive, let's say you only made 25 points off of that trade on 3 micros, that's still $300, $350, $375. $375 off of 3 micros on half of the points that I'm actually saying. And these exits are not like aggressive. These exits are 2 to 3 points from the peak. And if you took half of that, you're still making 375 on 3 micros. So anyway, I totally think. So to be clear, I don't think you have to. I used to think that you needed to be playing the ES in order to really be effective. But after having done micros long enough, as long as you're trading it correctly, micros is not a bad way to go. You're minimizing your risk. You're certainly not you're not over leveraging yourself, and you're giving yourself the comfort level of being willing to let it go 10 points and saying, I know that I feel like I'm going to make that money out of it, or even if you made, $100 versus losing 10. Anyway, you guys get my point. If a focus trade gives a signal on the NQ and later gives another signal on the ES after some time, can we take the trade together using? Yeah, here's the deal. There are days. In fact, there was a day where I actually was taking trades. Here's a perfect day. Here's a perfect day to describe what you were talking about. Balaji, I think is how I pronounce that. Okay, so on this day, this is the 26th. On this day, the very first focus trade that showed up was in the NQ at 10:01. The first focus trade in the ES didn't show up until 27. I took this focus trade, and this trade stayed in until 29. And so, oddly enough, I took this trade in the NQ. I actually didn't make it to get into this trade until it actually had a better entry. So I didn't get into this trade until it actually got. Actually, maybe I did lose on that initial trade, and then I got in a little bit later. But I didn't. But again, because I was going back and forth between the two, I ended up not getting. I didn't even take this trade at all. And I mean, obviously, because I mentioned earlier why I wouldn't have taken it, because it didn't really get a huge amount above, but also because it didn't, or I was in the NQ at the point where it would have gotten in. Because I think I had gotten into this trade and took it, but I didn't get in at that bad level. I got in a much more optimal level and got more points out of it, and then ended up taking this trade. And as you can see, this trade got in at 11:45. This trade got in 11:54. So I was in a trade when this trade occurred. When this focus trade happened, I was already in the NQ trade. There was no point for me to switch. So I ended up completely, and that's the thing is that it is not uncommon for there to be focus trades in one and not the other. And I mean, there's nothing rule-wise that says you can't take one or the other, or in this case, go back and forth between the two. But like on this day, the 10 o'clock trade, you can see that this is the ES, and the 10 o'clock trade on the NQ came at the exact same time. So it depends on the day, but I'm sure you get the point. It really is a matter of where the focus trade shows up that you potentially could be taking. You could be bouncing back and forth between the NQ and the ES on the focus trade, the focus trades you could take. But either one, again, it's a preference thing. If you're more leaning toward the NQ, and I will say that understanding how to trade the NQ versus the ES, it takes practice because the NQ is a little bit more volatile. But if you're versed on how to trade them both, there's no reason why you wouldn't potentially even take trades in both of them at the same time. As long as you're familiar and you're able to take those trades in that way. The bottom line is that they can be traded individually. And here's the thing to keep in mind is that focus trades are not limited. And just to give you guys an idea, and this is a longer term statement, but this works in many different types of tickers. It is certainly not limited to the ES and the NQ. And I'm going to give you an example here really quick. I just got to find the right day before I pull the chart over. So here's the GC. So on this day for gold, 30.3, because I think it goes by 0.1 per tick, you would have made 15.9 with 0.3 of heat for the gold on this day. And I'll switch it to show all the trades just so you can see it. So those are all the trades. But again, the focus trades are the ones, I mean, so what I'm telling you is this model of how this works. Now keep in mind, you can see I have all the value data on there. It just was below the fold. The focus trades work with any ticker. But again, this is not at all optimized for this. I haven't optimized this at all. So, I mean, there would need to be some level of optimization, but you can see, I mean, it works pretty well. 0.6 of heat for 21.9 return, or for potential. I should say potential because you're not getting that. That's just the maximum that it puts out. But I mean, that's the possible. So the reality is this can work for any number of tickers. It's just a matter of me having the time and the ability to be able to put it online. I would like to broadcast this, but it's not practical. I can't have 5 streams coming out of my house. At some point, the goal for me is to turn this into an actual indicator where you guys go to this website and you guys decide what date you want to look at and what ticker you want to look at, and whether or not you want to see the other trades or whether or not you want to just see focus trades. I mean that the goal is to get to that point. The long-term goal for me is right now, you can see all of these plays are based on very particular data that it looks at to determine when it should take what type of play. Should it take a type 12 to 11? All of these have different criteria that determine whether or not it gets into that trade. The goal will be long term is you could actually create your own versions of that data and say, I want to receive a signal when blah, 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 blah. And you would be able to set the criteria when Marketscore does this and the price does this and the sector data is telling me this. That would be the long-term goal. And then you could define your own criteria of what you want to see and when it will do alerts. But again, that's a longer term thing. But yeah, I mean, this model can work with many, many, many tickers. It is certainly not limited to ES and NQ. Okay. Anyway,
Thanks,
that's
Stacy.
it. That's
Thank
all
you,
I've
man.
got. If you
Thank
guys
you.
have if you guys have questions, you guys can ask questions in the Discord. I mean, please feel free. I certainly don't feel I as much as I am showing you guys what charts I've done and how I've done it, I certainly don't think that I am the all-knowing, trading god. That's if you guys have ideas or you have anything that you want information on, please let me know. The goal is to give you guys as much information as possible so that you can actually use it to be able to trade with Marketscore. The goal for me is to get this into people's hands so they can use it. And as just to make it clear, it's not that I'm here to make $1 billion, but at the same time, I can't do. I mean, I'll just tell you, to get to where I am right now, we're
It's a
talking
lot of work.
thousands of hours have been spent.
Yeah, it's a lot of work. I can see
Not
that.
all just on this particular thing, but like learning, realizing the pattern that I saw with the data of the call and put counts, being able to see that and then actually correlating it and then realizing I needed something, because Marketscore originated from me having a bot, an option trading bot, and realizing that just using the call and put data, it wasn't enough for me to really be effective at it. And so I created Marketscore in order to help the bot trade better. And then once my nephew, who's a trader, once he saw Marketscore, he was like, yeah, you need to focus on Marketscore. You need to market this. This is something that people can use.
Cool.
So anyway, thank you very much, everyone. I hope you guys have a great day. And again, if you have any information or any questions, please don't hesitate to reach out.
Thanks, Stacy. Appreciate it.
All right. Bye-bye, guys.